We are covering loan types and financing sources for the California real estate exam. This area makes up a significant portion of the financing section, which accounts for about 9% of exam questions. The test will expect you to know the key differences between government-backed and conventional loans, the mechanics of various loan structures, and the roles of different lenders. Let's start with the major loan types. Conventional loans are not insured or guaranteed by the government, meaning the lender assumes all the risk. Because of this, they typically require a higher credit score and a larger down payment compared to government-backed options. An exam question might ask you to identify the loan type that is not government insured. The answer would be a conventional loan. Now for the government-backed players. FHA loans, insured by the Federal Housing Administration, are a popular choice for first-time homebuyers due to lower down payment requirements, often as low as 3.5%, and more lenient credit score criteria. A common exam trap is to confuse insured with funded. The FHA insures the loan against default. It does not lend the money. VA loans are guaranteed by the Department of Veterans Affairs and are a massive benefit for eligible veterans, active duty members, and some surviving spouses. The exam will test you on their most significant feature, often requiring no down payment at all. Also, remember that the VA requires the property to be the veteran's primary residence and meet certain minimum property requirements, or MPRs, to ensure it's safe and sanitary. In California specifically, we have CalHFA, the California Housing Finance Agency. This is a state-level resource providing affordable loans and down payment assistance to first-time homebuyers who meet certain income limits and complete a homebuyer education course. An exam question could present a scenario with a low to moderate income first-time buyer in California and ask for the most suitable state-specific program. Then there are USDA loans, offered by the U.S. Department of Agriculture for rural and some suburban properties. Like VA loans, they can offer zero-down financing. The exam trick here is the definition of rural. Many small towns and areas on the outskirts of cities qualify. It's not just for farms. The property must be in a USDA-designated area, and the borrower must meet income limits, typically no more than 115% of the area's median household income. Now let's shift to loan structures. A fixed-rate loan has an interest rate that remains the same for the entire loan term, providing predictable monthly payments. In contrast, an adjustable-rate mortgage, or ARM, has an interest rate that can change over time. For the exam, you must know the components of an ARM: the index, the margin, and the caps. The index is the benchmark rate, the margin is the lender's profit added to the index, and caps limit how much the rate can change. There are initial, periodic, and lifetime caps that protect the borrower from extreme rate hikes. A question might give you a scenario with a starting rate, an index change, and a periodic cap, asking you to calculate the new interest rate. Interest-only loans require the borrower to pay only the interest for a set period, after which the principal must be paid, often in a lump sum called a balloon payment. Reverse mortgages are for homeowners aged 62 or older who have significant equity. They allow the owner to borrow against their equity, receiving payments from the lender. The loan is repaid when the homeowner sells, moves out, or passes away. A key exam point is the age requirement of 62 for the most common type, the FHA-insured HECM. Let's discuss lien priority. A first mortgage is the primary lien. Any subsequent loans, like a home equity line of credit, are junior liens. In a foreclosure, the first lien gets paid off first. A subordination agreement is a contract where a senior lien holder agrees to let a junior lien take priority, which is a critical concept for the exam. Seller financing is another key area. This is when the seller acts as the lender for the buyer. In California, for 1 to 4 unit residential properties, a seller financing addendum and disclosure form is required to ensure all terms are clear, especially regarding balloon payments and due on sale clauses. The exam may test your knowledge of these required disclosures. Finally, understand the different lenders and markets. Institutional lenders are banks, credit unions, and mortgage companies. Private lenders are individuals or groups that lend their own money. The crucial concept here is the secondary mortgage market. This is where primary lenders sell their loans to investors like Fannie Mae and Freddie Mac. This replenishes the primary lenders' funds so they can make more loans. An exam question will test this flow of money. Primary lenders originate loans, and the secondary market provides the liquidity. For a mnemonic, remember FHA insures, VA guarantees. It's a simple way to keep the primary functions of these two major government-backed loan programs straight under exam pressure. FHA provides insurance to the lender, while the VA provides a guarantee of payment. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.